Warren Buffett once admitted that his secretary pays a higher tax rate than he does. Think about that. One of the richest men on earth, paying a lower percentage of his income in taxes than the woman who answers his phone. That's not a scandal. That's not a glitch in the system. That is the system, working exactly as it was designed. And here's the thing. The same moves Warren Buffett uses to legally shrink his tax bill, most of them are available to regular people with regular jobs, regular salaries, regular lives. By the end of this video, you are going to understand three things. 1. Why high earners almost always pay a lower tax rate than you. 2. The specific accounts and strategies you can use right now to legally reduce what you owe. And 3. A real case study of someone who wiped out over $10,000 in taxes in a single year without a fancy accountant or a business. Let's get into it. Here's the first thing nobody tells you about taxes. The IRS doesn't care how much money you make. They care how you made it. Read that again. If you earn a salary from a job, the government takes their cut first before you even see the money. That's called ordinary income, and ordinary income is taxed the hardest, up to 37% at the top. But if you make money from investments, capital gains from stocks, rental income structured the right way, you could pay as little as 0%, legally. That's not a loophole. It's written directly into the tax code. Congress put it there on purpose. So the question is never, can I avoid paying taxes? The question is, am I earning and saving money in the right way? Most people aren't, and it's costing them thousands of dollars a year. Now, before we go deeper, I want to open a question in your head that I'll answer later. There's one account, a type of savings account, that the IRS literally cannot touch. Triple tax benefits, legal, available to most people who have a certain kind of health insurance, and yet almost nobody uses it the right way. I'll tell you exactly what it is and how to use it in a few minutes. But first, let's talk about the most powerful tool most employees already have access to and ignore. Your 401k is not just a retirement account. It is a tax reduction machine that your employer is offering you right now. Here's how it works. Every dollar you put into a traditional 401k comes out of your paycheck before taxes are calculated. So if you earn $60,000 a year and you put $10,000 into your 401k, the government only taxes you on $50,000. You just legally told the IRS, I made less money than I actually made. For 2024, you can contribute up to $23,000 into a 401k if you're under 50. If you're 50 or older, you can add an extra $7,500 on top of that. Let's say you're in the 22% tax bracket. If you max out your 401k contributions, you could reduce your tax bill by over $5,000 in 1 year without doing anything complicated. And the money doesn't disappear. It's still yours. It's just growing tax-deferred until you retire. Now, if you don't have a 401k through your job, or if you're self-employed, you can use a traditional IRA instead. Same basic idea. You contribute money before it's taxed, it grows, and you pay taxes when you withdraw it in retirement. Roth IRA works the opposite way. You pay taxes now, but your money grows completely tax-free, and when you take it out in retirement, you owe the government nothing. Neither option is universally better. It depends on whether you expect to pay more taxes now or in the future. But either way, the key point is this. If you're not using a retirement account, you are voluntarily paying more taxes than you have to. Now, remember that mystery account I mentioned earlier? Here it is, the Health Savings Account, known as an HSA. If you have a high-deductible health insurance plan, you can open one, and the benefits are almost unfair. Number 1, the money you put in is tax-deductible, so it lowers your taxable income right now. Number 2, the money grows tax-free inside the account. And number 3, when you spend the money on qualified medical expenses, you pay 0 taxes on it. That's 3 separate tax advantages in one account. No other savings vehicle in the United States does that. For 2024, you can contribute up to $4,150 if you're on an individual plan, up to $8,380 for a family plan.
And here's the part that most people miss. You don't have to spend the money immediately. You can let it sit and grow for years, then pay yourself back for any medical expense you've had, even old ones, as long as you kept the receipts. Doctor's visits, prescriptions, dental work, glasses, therapy, it all counts. The HSA is genuinely one of the most underused tax tools in America. If you qualify for one, you should be using it. Okay, now let's talk about a real person. Her name is Sarah. She's a middle school teacher in Ohio. She earns about $52,000 a year, single, no kids. And for years, she just let her employer withhold taxes and filed her return in April without thinking much about it. One year, she sat down and actually ran the numbers. She was paying over $8,000 a year in federal income taxes. That felt like a lot, so she made 3 changes. First, she started contributing $800 a month to her 403(b). That's the version of a 401(k) that school employees often have access to. That contribution alone knocked $9,600 off her taxable income. Second, she opened an HSA. Her school's health plan qualified. She contributed the maximum for an individual. That removed another $4,100 from her taxable income. Third, she had some losing investments in a brokerage account, stocks that had gone down. She sold them at a loss on purpose to offset a small capital gain she had from another stock she sold earlier in the year. That strategy is called tax loss harvesting. It's completely legal, and brokerages like Fidelity and Vanguard let you do it for free. When she filed her taxes that year, her taxable income had dropped from $52,000 to about $38,000. She moved into a lower tax bracket. Her refund was over $3,000 larger than the previous year. She didn't cheat. She didn't hire a fancy accountant. She didn't own a business. She just learned the rules and played by them, the same way wealthy people have been doing for decades. Now, let's go a level deeper because I promised to tell you why high earners almost always pay a lower rate than regular workers. We already talked about capital gains, but here's the part that really makes people's jaws drop. If you hold a stock for more than a year before selling it, the profit is taxed as a long-term capital gain. The rate? 0% if your income is below about $47,000, 15% if you're in the middle, 20% at the very top. Compare that to ordinary income, which can be taxed up to 37%. This is exactly what Warren Buffett was referring to. Most of his income comes from investments he's held for years. He pays the capital gains rate. His secretary earns a salary. She pays the ordinary income rate. The law treats those two types of income very differently, and that gap is entirely legal. If you have money sitting in a savings account or even in a money market, you could consider slowly shifting some of it into index funds. Over time, the gains from those investments will be taxed at a much lower rate than your paycheck. This is long-term thinking. It doesn't help you next April, but 5 or 10 years from now, it could save you more money than anything else on this list. One last thing. If you have any kind of side hustle, freelance work, content creation, selling things online, tutoring, anything, you open a completely different set of tax strategies. Business expenses become deductions, a portion of your phone bill, your internet, equipment you use, software, even a dedicated space in your home could qualify as a home office deduction. The IRS allows self-employed people to deduct their legitimate business costs before calculating taxes. The key word is legitimate. Keep records, keep receipts, don't make up expenses. But if you're already spending money to run a side business and you're not tracking it, you're literally throwing money away. Here's what I want you to walk away with. The tax code in America is long, it's complicated, but it was written with specific benefits built in for retirement saving, for health saving, for investing, for building a business. Those benefits are available to you right now, without anything illegal, without a team of lawyers. Most people just never take the time to learn how to use them. You just did. If this kind of content is useful to you, money, taxes, building wealth without gimmicks, subscribe because this is exactly the type of video I make. Practical, real, no fluff. And if you want to go deeper on any of these strategies, the HSA, the capital gains trick, tax loss harvesting, let me know in the comments. I'll make a dedicated video on whichever one you ask about most. See you in the next one.